Most new traders drown in subjective chart patterns and constant guesswork. To survive in the markets, you have to start by stripping away the noise and applying a strict, rules-based framework. Before we look at a single chart, you need to narrow your focus. This specific framework is calibrated for only 3 assets: the Euro-US dollar, the Pound-US dollar, and the gold market. Ignore absolutely everything else on your watch list. We are also going to completely ignore lagging concepts like market structure shifts. Instead, we use a rigid 6-step checklist that dictates exactly when to enter, where to place your stop loss, and when to just sit on your hands. By removing human emotion and forcing yourself to execute mechanical steps, you stop second-guessing your trades and begin operating with statistical confidence. Step 1 is establishing the battlefield. Open your charting software and set to the daily time frame. We need to identify the absolute upper and lower limits of the previous day's price action. Look at yesterday's daily candle. Draw lines at the highest and lowest wicks, labeling them previous day high and low. Zoom to the 15-minute time frame. Watch the price push upward and pierce straight through that high. Do not anticipate. Wait until a candle definitively crosses. These daily highs and lows represent massive pools of liquidity. Impatient retail traders get caught trying to predict the breakout. By waiting for the definitive sweep, we ensure we align our trades with actual institutional momentum. Once the daily level is swept, we wait for the price to reverse direction. Our only entry trigger is the very first fair value gap forming in this new direction. A fair value gap is a 3-candle sequence where the first and third wicks fail to overlap, leaving an empty space in the middle. Do not wait for a market structure shift much lower down the chart. By then, the optimal entry is gone. Striking at the very first fair value gap allows you to secure your position right at the origin of the reversal, long before the broader market recognizes the change in direction. Finding the gap is only half the equation. You must also apply a temporal filter. We only execute trades if the price returns to tap that fair value gap during designated high-volume windows known as kill zones. Set alerts for these 3 specific windows: 8 p.m. to midnight, 2 a.m. to 5 a.m., and 7 a.m. to 10 a.m. Eastern Standard Time. If a perfect fair value gap forms outside of these hours, you delete your order entirely. You do not force a trade when the market lacks the volume required to push the price to your target. Executing a technically sound setup during a dead hour often leaves your trade drifting sideways into a stop loss. Time of day determines your probability of success just as much as price action. Now, let's set the trap. Place a limit order precisely at the starting edge of the fair value gap you identified. To protect the position, place your stop loss exactly above the tip of the highest wick that swept liquidity. Next, pull your take profit down until your risk-to-reward ratio locks in perfectly at 2.0. Keep it at exactly a 2-to-1 payout. If you want to protect your capital further, wait until the price reaches a 1-to-1 ratio. Take partial profits there and immediately move your stop loss to your entry price. By enforcing this strict ratio, day trading stops being a stressful guessing game and becomes an exercise in mathematical probability. Once the order is set, walk away. The price drops, taps your entry limit, avoids the stop loss, and runs straight to the target. Because this framework enforces a 2-to-1 reward, the math works in your favor. You only need to win 33% of your trades to break even. You can lose 60% of the time and still grow your account. Losing streaks are a normal part of probability. If you abandon this system and hop to a new strategy after a few losses, you reset that math before the statistical edge has a chance to play out in your favor. The rules are set. Open your charting software right now, isolate yesterday's high and low, and manually backtest this exact mechanical sequence on your own charts.